Okay, good morning. Can you all see me and hear me well? Okay, thank you. I wait 1 more minute for other students to join and then we start. Okay, so last time we've been discussing scoring models, which are models that try to estimate the borrower PD, probability of default, based on past data, mostly accounting data, like financial statements ratios, but also indicators that come from the behavior of the borrower, past behavior, or from central credit registries. Generally speaking, however, there are always historical kind of data, and they can be used in different ways. We saw discriminant analysis, which is a technique based on the idea of maximizing the difference between bad and good borrowers based on historical data. But we also looked at more simple traditional regression kind of analysis like logit and probit models. Okay. Now, what we're going to do today is again focused on the estimation of a probability of default for a borrower, but it's based on a completely different idea, because basically what we're going to do is look at market data. How can we use market data? So if you want market prices, today's prices, current prices, to estimate a borrower PD. And because we're using market prices, in some way, the approach is completely different, because of course these prices incorporate the market expectations about the future of a borrower. Okay. So more specifically, what we're going to look at are, first of all, we'll say a few words about the general features of these models. And then we look at two main approaches. The first one is the one based on bond spread. So the idea is to look at how much more a bond yield to maturity, a bond yield is with respect to a risk-free rate, and use this difference, this spread, to estimate what is the implied probability of default. Okay. And we'll see that this way we can estimate so-called risk-neutral PDs, which are generally overestimating a real PD, and we'll see where this difference is coming from. Okay. Second approach is the one that actually looks at equity prices, equity data, rather than bond data, rather than fixed income data. And in doing so, we'll first introduce the Merton model, the model that has been produced by Robert Merton back in the mid-70s, with which he actually won the Nobel Prize. And then we'll see how this model can be applied in practice to estimate a borrower PD. Okay. So generally speaking, for some large borrowers, and of course this is a limitation of these kind of borrowers, because of these kind of models, because they can only be applied for those borrowers that have either they are listed in a stock market, or they have issued bonds which are traded in a liquid market. Okay, and therefore it's clearly not feasible for small companies, for SMEs. While clearly the scoring models, as they are based on accounting ratios, they can be used for any company. And we'll see that these sources of data can be elaborated with quantitative models. They tend to be forward-looking because they reflect the expectations in the market. But at the same time, this is an advantage, but also a disadvantage, as of course, it is suffering from the problems that we have with capital markets. Okay. Okay, let's look at the first one, which is very simply the one based on bond spreads. And basically, the underlying idea is very simple, and it's the following. When I want to look at the return on a risky bond, so a bond issued by a corporate, we could say that the 1 plus the risk-free rate is equal to 1 minus the probability of default times 1 plus the risky rate that is paid by a risky bond. Okay, so the underlying idea in this equation is I can get a certain given amount by investing in the risk-free asset, or I can invest in a risky asset, but of course I would only get as an outcome 1 minus the probability of default. In this case, we're assuming that if there is a default, I don't get anything, i.e. that the recovery rate, let's call it K, is equal to 0. So we can say that 1 plus R, the risk-free rate, is equal to 1 minus the probability of default times 1 plus, and this we can decompose that into a risk-free rate plus a spread D. Okay, so D would be the spread, the difference between R star and R risk-free rate. Okay, so if that is the case, 1 minus P would be equal to 1 plus R divided by 1 plus R plus D, and therefore the probability of default would be equal to 1 minus 1 plus R divided 1 plus R plus D, which is basically saying 1 plus R plus D minus 1 minus R divided 1 plus R plus D. And if you simplify that, you can see that basically what we're left with is that the probability of default is equal to the spread divided by 1 plus R plus D. Okay? So this equation is basically telling us what would be the implied probability of default given the spread of a risky bond, okay? Which is basically the equation that you have here, okay? So as an example, if the risk-free rate is 4% and the risky rate is 5%, then the probability of default would be 0.95%, okay? Now here we've been assuming that the recovery rate is 0, okay? Now, if we assume that the recovery rate is positive, then the equation that we saw, i.e. this equation, 1 plus R plus D, becomes, with a positive recovery rate, the following. 1 plus R plus D times 1 minus the recovery rate. And that's what you see here, okay? Now, clearly, if you look at this, this is basically telling you that given a spread, okay, given a spread, say, for example, like the 1% that we saw before, if there is a positive recovery rate, then the probability of default, which is implied in the spread, is larger, is higher, other things equal, okay? Because basically you would have to compensate for the fact that there is a positive recovery. Okay. So in this case, for example, with the same data, you see in this example, the risk-free rate is 4%, the spread is 1%, and we have a recovery rate of 50%. Then the implied PD is basically the double of the previous example. Okay? So that's very simply how you can infer the probability of default of a borrower from its outstanding bond spread with respect to a risk-free rate. Okay. Now, another assumption, very important assumption that we made, or that we have to keep in mind, is that we started from this very simple equation, i.e., 1 plus R is equal to 1 minus the probability of default times 1 plus the risk-free rate plus the spread. Now, basically, as you can see from this equation, the assumption that we implicitly made is that of risk neutrality, i.e. that an investor would be indifferent in terms of the expected outcome between an investment that has no risk at all, because it's a risk-free investment, and an investment that clearly has a risk component. Okay? And we're basically assuming that an investor would be indifferent in terms of the expected value of these two investments, even if, of course, one has an uncertain outcome. And we know that in reality, investors are risk averse, and we're not taking that into account here. Okay? Okay. So that's basically the equation that we saw before, and we can see how things would be changing. Okay. Now let's look at a few numerical examples to see what could be done in terms of the data that you can extract. Here are the two curves for risk-free rates for different maturities. You can see that the risk-free rates are slightly increasing with time. So the 1 year is 4%, the 2 years is 4.1%, and so on. And you also have the risky rates for the different maturities. So we can see that also the spreads between the two rates are an increasing function of time. The spreads for different maturities are actually increasing over time. Okay. Now, based on this spot rates, i.e., interest rates at time zero, we can actually compute the forward rates. Okay. I.e. the rates implied in the spot rates for future periods, okay? And you can see clearly when the curve is upward sloping, the forward rates, which are the rates for future periods, are above the spot rates, okay? So for example, the 1 year rate is 4%, the 2 year rate is 4.1%, therefore the interest rate for the second year is 4.2, so it is higher than the previous two. Okay, for the very simple reason, as you well recall, that basically the 1 plus the interest rate from 0 to 1 times 1 plus the interest rate from 0 to 2 is equal to, from 1 to 2, which is the forward rate, is equal to 1 plus the interest rate from 0 to 2 squared. Okay, so we can take that out, and of course, if the rates are increasing, this would be above the 2 year rate. Okay, which is what we see here in this data, and it can also be graphically represented in this chart. Okay, so the spreads are also an increasing function of time, as we can see in this chart. Higher forward spreads, positive slope of the spread curve, which means basically that not only we have an expectation of increasing interest rates, but also of increasing spreads, which in some way reflects also an expectation of increasing probabilities of default. Now, the point I just want to make is that using forward spread, one can estimate the marginal probabilities of default for future time periods. Okay, so for example, in the previous numerical examples, we looked at how we can estimate a probability of default, like P, for example, from 0 to 1, and that was actually equal to the spread from 0 to 1 divided 1 plus R plus D, okay? And if there is a positive recovery rate, this has to be multiplied by 1 minus K. Now, the same reasoning can be used, the same equation can be used to estimate, for example, the probability of default implied in the market rates from 1 to 2 years, i.e., what the market is expecting in terms of the probability that the borrower will default, not in the first year, but in the second year. And this, of course, would be based on the, on the forward spread, i.e., 1 to 2, divided by 1 plus R plus D, again from 1 to 2, times 1 minus K, okay? So not only we can use interest rate spreads to estimate spot probabilities of default, but also the forward ones. And here, with this example, it would be 228%. Now, clearly, using the probabilities of default for the first 2 years, i.e., for the one from 0 to 1 and the one from 0 to 2, from 1 to 2, which were, remember, were 1.9 and 2.28, we can also estimate the marginal survival probability, okay? Which the survival probability, of course, is simply 1 minus the probability of default, okay? And so, based on these probabilities of default for the first and the second year, we can also compute the survival probability for the 2 years, okay? So as you can see in these equations, for example, the survival probability from 0 to 1 is simply 1 minus the probability of default, i.e. 98.1%, okay? Now, if we know that in the second year, the probability of default is 2.28, then we can actually look at the survival probability for the second year. So how many of those that will survive after 1 year will also survive after 2 years, in the second year? And therefore, based on the two survival probability for the first and the second, we can compute the cumulative survival probability, which is the product of the two, i.e. 98.1 will survive after the first year, and out of these 98.1, 97.7 will survive the second year. So in 2 years, the survival will be 95.86%. So, and of course, based on that, we can compute the probability of default, the cumulative one, after 2 years, which is just the difference between 1 and the survival probability. So these are just some computations that are typically used in mortality tables by rating agencies, and are quite interesting to know in terms of understanding probabilities of default evolution over time, okay? So here you have a table that summarizes, based on the data that we saw above, simply on the data concerning the spreads between a risk-free rate curve and a risky curve. And you can see that from them you can derive probabilities of default, marginal probabilities of default, marginal survival probability, and so on, okay? Now, to recap, what are the advantages and the pros and cons of this approach to estimate PD? Now, the advantage is that we're using market data, so it's forward-looking, okay? And the second one is, sorry, that is we use market data, so objective, and second, that it's forward-looking, okay? On the cons, what are the weaknesses? Well, in some way, those are the assumptions that we make. Okay. First of all, we assumed that expectations theory is true, i.e., that the spreads correctly reflect the market expectations and do not reflect other factors. So that could be, for example, liquidity premium, transaction cost, credit risk, and so on. Okay? And finally, the most important one is that we assumed investors to be risk neutral. That's probably the most important weakness of this approach. And as I mentioned, of course, it can only be applied to companies, corporates that have bonds outstanding that are traded in liquid markets. Okay. Now, before we move on, let me just simply mention that we use the simple compounding, but of course we can also use continuous compounding. Okay. And here you have a few examples. Now, the equation to estimate PD is the one you see here. The probability of default is 1 minus the exponential of my d, which again d is the spread. Okay, and you can see that using continuous compounding, there is an advantage, and that is that we don't actually the probability of default. It is not a function of the level of interest rate. Okay. So basically, with continuous compounding, we have this kind of equation for the PD, while with simple compounding, remember we had d divided by 1 plus r plus d. Here we are assuming that the recovery rate is 0. So in simple compounding, the PD is also a function of the level of interest rates. Okay. Now, the advantage of continuous compounding is that it only depends on the spread between a risky rate and a risk-free rate. Okay. Now, of course, we can use the same equation, assuming that the recovery rate is positive, and in this case, it becomes the following: i.e., we would also include a denominator of 1 minus k, like we did with simple compounding. Okay. And of course, if it's more than 1 year, okay, like we've been looking at examples with the 1 year PD. If it's more than 1 year, then of course we would also have a time factor here, as you can see in the equation. T is capital T is the number of years related to the period. Okay. Okay. Now, one point that I want to show you, if we want to understand what's the kind of bias that we get by using that assumption of risk neutrality, is to look at alternative sources to estimate default probabilities, like the ones provided by rating agencies. Okay. For example, this is a table from Standard & Poor's, okay? And it's a default rate table that shows what is the cumulative default rate for different borrowers of different rating grades for different maturities, okay? So as an example, a single A borrower has a probability of default in 1 year which is extremely low, in the order of 0.06%, while it becomes more significant, i.e. 0.67% in 5 years. So these, of course, are tables that get updated every year, but generally speaking, so they may change over time, but generally speaking, we could say approximately the probability of default for a single A borrower, which is a very good credit quality, in 5 years' time is 0.67%. How is this computed? Very simply, they take all the borrowers with a single A rating and they monitor them over time, and they see that after 5 years, 0.67% of them actually default. Okay. Now, if we look at, if we want to compare this probability of default with the one that comes out from spreads, like using the methodology that we described so far, we can look, for example, what is the spread that an A-rated bond usually pay with respect to a 5-year treasury, i.e. a risk-free rate, okay? And this it has been traditionally, of course, spreads move over time. For example, they were relatively low before the great financial crisis, then they increased a lot, then they get back down again. But let's say that on average, a single A-rated bond pays approximately 50 basis points above a 5-year treasury, okay? So a 5-year risky bond, A-rated, pays about 50 basis points over a 5-year treasury, okay? It could be a bit lower, it could be a bit higher, but this is generally the level, and it doesn't really affect if we use 40 or 60 basis points, the result that I want to show you, okay? Now, this means that the present value of the loss expected over the next 5 years is 2.47%. So if we use this spread and we compute the implied probability of default using the equation here, okay, then we get an implied probability of default, which is 2.47, or let's say better, an expected loss. Then we should actually take into account that there is an LGD, i.e. a positive recovery rate. And if we assume that the recovery rate is about 30%, which is close to the empirical values, then the implied PD would be a bit higher, okay? Remember, when we start from the same spread and we assume that there is a positive recovery rate, then the implied PD is, other things equal, is higher. And it would be 353%, okay? Now, this probability of default, which is implied in the spread, is much larger than the historical PD for a single A bond. Now, we saw that the default frequency here, the default rate, which is a proxy of the PD, was 0.67%. Here we got 353, okay? Now, where is this significant difference coming from? Now, this difference is actually coming from the assumption of risk neutrality that we made. The truth is that when we look at the spread, okay, in reality, the spread not only reflects the probability of default, but it actually reflects risk aversion, okay? So basically, the point is that given that spread, a very significant component of that spread is not related to the expected loss associated to the probability of default, but it's compensating the investor for the risk he's taking, he or she is taking, and it's basically driven by risk aversion. Okay, so that's basically the main reason why risk-neutral PDs, like the ones that can be estimated from bond spreads, they're called risk-neutral PDs, tend to be larger than the real PDs. Okay, then let's say the empirical default frequency. Okay. But clearly, and that's what is in these slides, the value of P that solves the equation without R is higher than the value of P that solves this equation. Default probability based on historical data, real world probabilities, and in the real world, better expectations of default risks are offset by the fact that investors require a risk premium, okay? Because this is a risky lottery, okay? And therefore, this is very important to keep in mind. However, risk-neutral PDs are very important because they are used in a number of, for example, asset pricing models, okay? Okay. So this is as far as the first part is concerned, i.e. Bond spreads. Is there any question of what we saw so far? There is a question on something I saw before. multiplying the two survival probabilities, aren't we assuming that they are independent? So that's what we did here. Exactly here. Are we assuming they are independent? Let me think about it. Well, we are assuming that 98% of the firms, the borrowers that were alive at the beginning of the first year actually survive, okay? And then we are assuming that in the second year, out of this 98%, 97.7% of them actually survive, okay? I don't think we're assuming that they are independent. Because, I mean, the ones that actually did not survive simply are not there anymore, okay? And so then we're not treating them like two independent events that take place at the same time. We're actually considering two separate events that are taking place over different time periods, okay? So I don't think that here we are necessarily assuming that there is independence. We're just saying that out of the ones that actually survived in the first year, only 97.7% survived in the second year, okay? Okay. Should we always calculate cumulative PDs from marginal ones, or we can use spot rates directly? No, that's a good question. We can also use, let's say, cumulative PDs from the longer term spreads, okay? Exactly as you mentioned, for 2-year cumulative PD estimate, we can use the 2-year spread. That's correct. Yes, I just wanted to show you the components of those PDs, okay? Okay, so if there are no additional questions, we now move to the second part, which is the one based on, if you want, equity prices, okay? And before looking at some examples, we'll take a quick look at the Merton model that you may have already analyzed in other courses, and what is the logic behind this model, okay? So the Merton model is, in some way, the intuition is very simple, right? And, sorry. Let me reestablish the share screen. Now, the idea behind the Merton model is very simple. First of all, the idea is a borrower, a company, has assets, debt, and equity, okay? In the Merton model, debt is just one form of debt, and it's a 1-year zero coupon bond, okay? So it's very simplified, okay? Only one maturity, 1 year, okay? The intuition behind the Merton model is very simple. That is, assets in the Merton model, pay attention, they're not accounting assets. We're talking about the market value of assets. And the market value of assets is basically the present value of the future cash flows that are going to be produced by the company, okay? Debt is the face value of debt, okay? And the intuition behind the Merton model, very simply, is okay, a borrower would default if the asset value shrinks and basically becomes lower than the value of debt. If the value of the asset becomes lower than the value of debt, then of course we have default. And that's very simple, and you might say, okay, I could have won the Nobel Prize myself too, a very simple intuition, okay? But of course, there's a bit more behind this model, okay? What is more? Now, the model is based, first of all, we might mention that the value of the borrower's assets evolve over time following a geometric Brownian motion, where the expected instantaneous yield on the asset is assumed to be the risk-free rate. So it's assumed to be a very low rate, okay? And we'll get back to this assumption because it has some implication. So practically, the asset returns evolve stochastically, and the uncertainty as to their future path increases with the time horizon. But to give you an idea of the intuition behind the Merton model, let's look at this chart, which is the most effective. Now, here we are today. See the point in time. Now on the x-axis, you have time, okay? On the y-axis, on the vertical axis, you have the company's assets value, okay? The value of the assets. Now, we are in the middle at today, time today. So we know how the assets value has evolved over time in the past, okay? We do not know where it will go in the future. There could be many different possible paths of evolution of the asset value in the future, okay? This is the asset value today, okay? See here in the middle, the value of the assets today. And at this very moment in time, this is the value of debt, okay? You see the horizontal dotted line, which is the value of debt, okay? And the vertical dotted line is the time today, okay? Now, the asset value can evolve in many different directions and paths over time. And the only thing we're assuming is that after 1 year, the distribution, the probability distribution of all the possible future values of the company's assets is a normal distribution, okay? Now, if this is the case, what we know is that if the asset value goes below this threshold, which is the value of debt, the dotted line, then there will be default, okay? Then there will be a default because the value of the assets would be lower than the value of debt. Therefore, the company would have negative equity, and therefore there would be a default, okay? Now, if this is the case, then this area in brown, or if you want red, is the default probability of the company, okay? So if we want to estimate the probability of default, it's just trying to understand what is the value of this area, okay? Now, if you think about it, what does the probability of default depend on? Now, first of all, it depends on financial risks, i.e. leverage. How much debt we have with respect to the value of the assets, okay? Other things equal, if debt were lower, of course, the probability of default would be lower, okay? So the first component that is affecting the probability of default for a company is the difference between the value of the assets and the value of debt, which at the end of the day is leverage, i.e. financial risk, okay? The other component that is affecting a company's probability of default is the volatility of the asset values. Now, if we had a very low volatility, clearly this distribution would make it the probability of default very low, okay? With very high volatility of the asset values, of course, other things equal, the default probability would be higher, okay? Finally, we don't see that in the Merton model because the Merton model is based on just one liability, which is a zero coupon with 1 year maturity. So we only have one maturity. But we can also see that the other things equal, the longer the maturity of the debt, the higher will be the probability of default, which is consistent with what we see in real life data. Okay, think about the table from Standard & Poor's that I showed you earlier. Okay, so this is very important because from this very simple chart, we can see that the Merton model is identifying the two structural features of a company that affect its probability of default. One is financial risk, leverage. The other one is business risk, the asset volatility. Remember, the asset value is the present value of future cash flows. If there is a lot of uncertainty about the future cash flows, of course, there's a lot of volatility. So this is very much reflecting business risk. I mean, if you were running a utility company or a supermarket, the uncertainty about future cash flows is very low. And therefore, asset volatility is very low because business risk is low. Okay. If you are running a high-tech company, a biotech company, there's a lot of potential, but there's a lot of uncertainty, i.e. a lot of asset volatility. And that's business risk. So the two components affecting a company's probability of default are financial risk and business risk, the two structural features of a company. And that is why the Merton model is considered to be a structural model, i.e. it's actually identifying the structural features of a company that lead potentially to default. So as we said, a company's PD can be expressed as the probability that the future value of the assets is lower than F. F is the face value of debt. And all other things equal, this area increases as the starting value of the asset decreasing, the nominal value of debt increases. So these two components are financial risk, leverage, the volatility of the market value of assets, and the debt maturity. Okay. Given the maturity, the first three variables represent all relevant information. Okay? That's what we just said. Okay? Now, what is the next step of the Merton model? The next step is to introduce option theory. Basically, the underlying idea is that shareholders have the option of handing over the company to the creditors rather than paying back debt if the value of the assets has gone below the value of debt, if V has become lower than F. Okay. Basically, it's a bit like it's a bit as if the lender, so say for example the bank or the bond investors, have written a put option, have given the shareholders a put option, whereby the shareholders have the right to sell the company back, to sell the assets of the company back to the lenders, to the bond investors, if the value of the asset has gone below the value of debt. Okay, and this can be seen graphically here. It's a bit. This is the payoff of the lender, or if you want, the payoff of the bond investors. Okay, it's a bit as if they have sold the put option. So as you can see, this is the payoff of a put option seller to the company's shareholders. Okay. On the x-axis, we have the value of the assets, and this is the value of debt. And on the y-axis, we have the payoff to the debt holders. Okay. Now, if this is the case, then if we say that the lenders, the bond investors, have sold the put option to the shareholders, then we could say that they could hedge their risk by buying a put option on the underlying company's assets. Okay, So let's look at this with a simple framework. Now, in this table, what you have is the first item is the loan, okay? And what we could do is look at the payoff at maturity. Remember, we assume to have a loan with a maturity of 1 year, okay? What happens to the lenders at maturity? Now, at time 0, they lend money, which is the present value of the bond, and we have a cash outflow, which is B0, okay? We are the investors, the bond investors. At maturity, it very much depends whether the company is still alive, i.e. the value of the assets is larger than the face value of debt, okay? So in this case, the bond investors get back the face value of debt, okay, F. However, if the value of the assets is lower than the value of debt, then the company defaults and the lenders get back only the value of the assets, which is lower, okay? So that's the cash outflow at the 0, and those are the payoffs at maturity, depending on whether the company is still alive or it actually defaulted, okay? What about if I buy a put option on the value of the company's assets with a strike price equal to the value of debt, F, okay? Now, if this is the case, at time 0, I pay the option premium, P0. At maturity, if the value of the assets is larger than the strike price, I don't get anything, because the market price is larger than the strike price, so that's a put option, I don't get anything. If it is lower, then I get the difference between the face value of debt and the value of the assets, okay? What about if I combine these two? We can see that if a lender buys a put option, assume that there was a put option available on the company's assets, then the final payoff would be at time 0, the present value of debt plus the put option premium. This is a cash outflow. And at maturity, I get a given value of F in both scenarios, okay? So basically, there would be no risk at maturity. I'm basically getting F for sure. And therefore, I can say that the value of these two components is equal to the present value of this future F face value of debt discounted at the risk-free rate because there is no risk, no uncertainty about this outcome, okay? So the conclusion from this framework is that the value of debt today plus the premium on a put option on the company's assets with a maturity which is equal to the debt maturity and a strike which is equal to the face value of debt is the present value of the face value of debt, okay? Now, if this is the case, then we could apply option pricing to compute the premium of the put option using the usual option pricing formula, Black-Scholes, okay? And therefore, we can now use it to estimate the value of debt, the equilibrium spread, and also the company PD, okay? Let's get back to this equation. We put the two equations together, okay? And therefore, we get that the value of debt, okay, the value of debt is equal to, we just have the put option price, okay, plus the present value of the future of the face value of debt, and we get this equation, okay? We can see, for example, that the market value of debt is larger, the lower is leverage, okay, which is consistent with intuition, and the lower is debt maturity, which again is consistent with intuition, okay? But not only we can compute the market value of debt, we can compute the equilibrium spread, okay, using this model, okay? And here it is computed, for example, for different levels of leverage and different values of the volatility of the company's assets. So if you want, for different values of financial risks and for different values of business risk, okay? And as you can see, this spread is an increasing function of asset volatility and an increasing function of leverage. Okay, these are all. This is all in the Excel files that you have. Okay, all these computations. Okay, this is the one. Okay. Plus, we can compute the probability of default. But what is the probability of default in this framework? Well, basically, the probability of default is the probability that the value of the assets at maturity is lower than the face value of debt, but that is the probability that the option gets exercised, okay? And we can compute the probability of the option being exercised, which is 1 minus MD2. So again, if we provide a numerical example with a given level of leverage and asset volatility and risk-free rate, we can compute the probability of default. And again, here are some examples. Here is the probability of default with given levels of financial risk and business risk, i.e. leverage and asset volatility, very high here in those first two columns on the left part of the table, and much lower in the second part of the table, in the right part of the table. As you can see, here the PD and the spreads are much lower, okay? Because there is much lower financial risk and business risk. But basically, you can use the model to compute the PD and the equilibrium spread, okay? Now, one interesting thing that you see from this computation, so if I report on a chart these values, okay? So if you want, the ones on the left are kind of the values for a very risky company, high leverage, high asset volatility, high financial risk, high business risk, okay? So this is the evolution of the spread over time for a risky company, and this is the evolution over time of the spread for a low-risk company, okay? Now, those are reported here, and as you can see, there is a very interesting result. And this interesting result is that for good quality borrower, the spread is an increasing function of maturity. For a bad quality borrower, the spread is a decreasing function of maturity, okay? So the term structure of credit spreads is very different for low quality borrowers, high PD, and high quality borrower, low PD, okay? Why do you think they behave so differently? What do you think? And by the way, this is very consistent with reality. If we observe the term structure of the spreads for low-rated companies and high-rated company, we see exactly this kind of behavior. Where is this coming from? Anyone has any idea? Now, the underlying rationale can be seen in this table, which are marginal default probabilities for a 25-year period from Moody's for different rating grades, okay? So those are marginal default probabilities, not cumulative ones, okay? So basically, they show, for example, these values, what is the fraction of AAA rated borrowers that default the first year, that default in the second year only, in the third year, or in the 10th year, okay? And what you see from this table, which is coming from empirical data, which is very interesting, is that the marginal default probabilities are increasing with time for good quality borrowers. So, you know, a AAA borrower has a almost zero probability of defaulting in the first year, but they do have a much higher probability of default in the 10th year. And the reason is that a AAA borrower might not default in the first year, but it could be downgraded. And so they could be downgraded over time, and at the end, they become more likely to default. If you look at bad quality borrower, i.e. in the bottom part of the table, it's exactly the opposite behavior. The marginal default probabilities are decreasing with time, okay? And that's because basically those bad quality borrowers have a much higher probability of defaulting in the first 1, 2, 3 years. Okay? But if they do not default and survive, they typically get upgraded, and then their probability of default in the future years actually decreases. Okay? So basically, this behavior of the spreads over time is very much consistent with this empirical evidence, which is what explains in the market the shape of those term structure of credit spreads. Okay? Okay. Any questions so far on the Merton model? Okay. Now, what are the advantages of the Merton model? Now, first of all, the Merton model allows to clearly identify what are the key variables that underlying the risk of default for a company, which, as I mentioned, are leverage, i.e. the financial risk, and asset volatility, i.e. the business. And second, that it actually allows to estimate through objective and clear criteria the borrowing company PD and the risk premium that the equilibrium risk premium, the equilibrium spread. Okay. It has, however, a number of disadvantages because, and those disadvantages are basically related to its underlying assumptions. I mean, it's assuming just one debt, which is a zero coupon bond. It only looks at default risk. Okay, it's not taking into account migration risk, i.e. the risk that a borrower gets downgraded. I mean, the model only looks at either default or non-default. The main problem in actually using this model in practice is that some variables cannot be empirically observed. So, for example, we did all the calculations in these tables, and you have them on the Excel files, by assuming an asset volatility and an asset value, market value. But we don't see that. I mean, we only see the accounting value of the asset, not the market value, and there's no way we can observe the volatility of the assets. Okay. On top of that, it's assuming a constant risk-free rate, and it's based on, like all option pricing models, is based on an arbitrage-free logic, i.e. the possibility, the idea that you can buy and sell the underlying asset of the option, which are the company's assets, which clearly it's not realistic to assume. Okay. Now, other problems are related to the assumptions on recovery rates and normal distribution of the asset value returns. Okay. Now, there is an alternative that we could actually use to overcome the empirical problems that I mentioned in terms of the estimating the equilibrium spread and the borrower PD. And the way we can do that, which is what we're going to see with the KMV model, is that just as we can see the position of a lender as the one who has sold a put option to the shareholders, then similarly the shareholders have a payoff which is equivalent to that of someone who has bought a call option on the underlying company's assets. If you think about the payoff of the shareholders, so in this chart again you have on the x-axis the value of the assets of the company, and on the y-axis you have the payoff of the shareholders. Okay. Now the shareholders have a payoff which is equivalent to the one of someone who has bought a call option on the value of the assets. meaning that if the assets of the companies are equal to the face value of debt, the payoff is zero, okay? Because the assets all go to the debt holders. But as soon as the asset value increases above the value of debt, then the payoff starts to increase and increase indefinitely, just as the one of the payoff of the call option, okay, based on as a function of the underlying asset price, okay. Now, if this is the case, then in the case of the equity, we can observe something empirically. We can observe the value of the equity, okay, which is the market cap of a company, and we can observe the volatility of the equity, which is the volatility of the stock market or the stock price return, okay? Clearly, only if we have a listed company, okay? Now, what is the underlying idea then that we could use? First of all, we know that the equity can be seen as a call option, okay, on the company's assets, again with maturity 1 year, and strike price the face value of debt, okay? And this is the first equation we can use. The value of equity, if the company is listed, we have it, is the market cap of the company, okay? The second equation we can use is the one you see here. Now, as you can see, we are basically relating the equity volatility, sigma E, to the asset volatility of the company, so the volatility of the company's asset, which is sigma V. Now, you can see intuitively that, let me show it to you with a chart. Oh my God, again. Now, what I want to show you is the following. This is the company's structure. We have assets here. Well, let's call them as in the equation V. We have debt and we have equity, okay? Now, these assets are characterized by a given volatility, which is sigma V, okay? Now, this asset volatility, which is the company's business risk, okay, gets transmitted in a volatility of the equity, assuming that debt is fixed, okay, and has to be reimbursed at maturity. So basically, there is a relationship between sigma E and sigma V. And as you can see, because this is assumed to be stable over time, the volatility of the assets gets transmitted in an amplified way to the volatility of the equity, which is a function of leverage. So the higher is leverage, the higher is the volatility of the equity given the volatility of the assets, okay? And that's exactly what you see in this equation, which is the second equation. As you can see, the volatility of the equity is a function of the volatility of the assets, but gets amplified by leverage. The higher is leverage, the higher is the volatility of the equity given the volatility of the assets, okay? So now we have two equations. The first one is the value of the equity as a call option, and the second one is the volatility of the equity, okay? And we have two equations with two unknowns. What were the two variables that we did not have? One is the value of the assets, the other one is the volatility of the assets. So we can put these two equations with two variables that we can observe in the market if the company is listed, the market cap and the volatility of the stock price return, and we can use those two equations to estimate the two unknowns, the value of the assets and the volatility of the assets, okay? This is done in this example, for example. And again, this is taken from the Excel file that you have, okay? Which is the one here, okay? Yes, this is the example. And basically, it's assuming that we have a company with a market cap of 10 million. The standard deviation on a yearly basis of the equity return is 50%, so very high. The nominal value of debt is 90 million. The risk-free rate is 5%, and the debt maturity is 1 year. Now, the intermediate outputs, I mean, the two unknowns we were looking for, the market value of the assets is 95 million, and it can be estimated both based on those equations. And the standard deviation of the asset volatility, sorry, is 5%. Okay. So as you can see, we actually have an asset volatility of 5%, and then gets transmitted, given the high leverage, 50% equity volatility. Okay. Now, with these inputs, we can then apply the Merton model, and we can compute the market value of debt, the equilibrium spread, the equilibrium rate, and the risk neutral probability, which is 2%. Okay, and this is again a risk neutral probability. Okay. So to recap, the Merton model, as we said, is a structural model. Okay. Which reflects the structural features of a company, its financial risk, which is leverage, and its business risk, which is asset volatility. There have been a number of let's say, of the derived models from the Merton model. There are plenty of them that try to improve the basic Merton model in different ways, removing many of the assumptions. For example, the normal distribution assumption, for example, the assumption of just one debt with 1 year maturity, zero coupon, by using multiple layers of debt with different seniority and subordination and so on. Okay, but I just wanted to show you the basic idea. Okay. Finally, the last model I want to show you is the KMV model. KMV was a company founded by three economists. Kielhofer, V. Svazicek, and M. Well, I don't recall the third one. And this company, which was based in California, was then acquired by Moody's and became Moody's KMV, a very successful company. Now, this company is providing probabilities of default estimates based on the logic that we saw so far, okay? But it's actually using a proprietary model, which is using some adjustments to the one framework that we saw so far, okay? What are these adjustments? First of all, not all companies' debt is thought to be due at the end of the first year. More specifically, the face value of debt in the KMV model is replaced by the so-called default point. And we'll see what we mean in a minute. Second, we're not assuming a normal distribution. We're actually replacing it by an empirical one, and we'll see how that is actually made. And finally, the link between market data and PD is made much more stable through a particular kind of mechanism. And I'll show you now what that means. Now, first of all, the KMV model introduces the concept of default point that you see here, okay? And the default point for the KMV model is not the face value of debt, it's not all the debt, but it's only the short-term debt plus half of the long-term debt. Okay, you have it in the next slide, don't worry. So basically, the underlying reasoning is we believe that if a company's asset value is below the amount of debt, that does not necessarily lead to default, because this is certainly true for the short-term debt, because that has to be paid back soon. But it's not necessarily true for the long-term debt, because we have a long time before maturity. So for simplicity, the KMV model takes as default point the total amount of short-term debt plus 50% of the long-term debt. Okay. Second, the KMV model introduces the concept of so-called distance to default. The distance to default, as you can see from this chart, is graphically the distance from between the expected asset value, the current asset value, and the default point. Okay. More specifically, the distance to default is estimated as the difference between the asset value and the default point, standardized by the standard deviation of the asset. Okay. So the default point is short-term debt plus 50% of the long-term debt. And then we introduce this concept of distance to default. Okay. The second phase in the KMV calculation of PD is very much empirical. And what they do is they take a large number of listed companies, and what they do, they compute their distances to default, okay, by looking at the default point and the distance to default using the standard deviation of the asset and the asset values that are computed using the framework we saw before, i.e. based on equity value and standard deviation of the equity. So then they construct a system of, if you want, rating grades. So all the companies that have a distance to default which is approximately equal to one standard deviation of the asset. Remember, distance to default is expressed in terms of multiple of standard deviation, standard deviation, asset volatility. So all these 9,000 companies have a distance to default which is more or less one asset standard deviation. Those 15,000, two asset volatilities. These 20,000, three asset standard deviation, and so on. Then we look at how many of those companies after 1 year actually defaulted. Okay, and of course, those companies that have a lower distance to default, i.e. they are closer to default, they are more likely to default and therefore have a higher default frequency. Okay, and therefore, based on a company distance to default, one can estimate what is the probability of default, which is an empirical kind of data. And those PDs are actually called, in the KMV, Moody's KMV model, they're called expected default frequencies. They're called EDFs, okay? So basically, a company PD is a function of its distance to default, okay? And therefore, the probability of default is very much an empirical data that we take from the default frequencies of companies with different distances to default. Okay. So let's look at a few, let's say, simple examples of the past. For example, a major default was Enron, and you probably heard about an energy company in the US. And if we look at different indicators, for example, this dotted line in the middle, these are the months before default. Okay. Default took place here, October 2001. These are the agency rating, the dotted line, never actually moved until default, okay? This gray one is the Altman Z score that actually got worse close to default, okay? And this is the EDF. as you can see, the EDF started to move much earlier and significantly increased before the fall, okay? Because it's a market-sensitive kind of PD estimate, okay? This is for WorldCom. Look at the rating. The S&P rating never moved until the very end, okay? When it got downed many times in a very short period of time. This is the Z-score. This is an inverted scale. And this is the EDF. The EDF started increasing very much earlier, okay, before the fall. So it's more sensitive to market conditions, okay. So to recap, the KMEMV model has a number of advantages. It's forward-looking, okay. It does not require the borrower to issue bonds because we can look at the market cap and the equity volatility, because then we can use them to estimate asset volatility and asset value. They can be used to measure the PD, the EDF, on a single borrower basis, while in the case of, for example, rating agencies, we pool them together for rating grades. And they're relatively stable across economic cycles. I mean, they don't fluctuate a lot. And this is because they are kind of point in time. And let me show you what I mean by that. Now, to give you an idea, when we talk about ratings, we have two main type of ratings. One are the so-called through the cycle ratings. Through the cycle ratings are typically the ratings of the rating agencies, okay? So S&P, Moody's, Fitch, and so on, okay? And the second one are so-called point-in-time ratings. What is the difference between these two? These are typically the internal ratings of banks, but they're also consistent with the rating of KMV, the ADFs, okay? Now, what is the difference? Now, through the cycle ratings from rating agencies, basically try to evaluate a borrower stressing the economic cycle. So basically, assume this is the evolution of the economic cycle. Of course, I'm a bit exaggerating. Let's say that this is, for example, GDP growth, okay? And this is time, okay? Now, basically, the idea is for the rating agencies, they try to stress the conditions of the borrower and see how he would behave in assuming a downturn. So even if we are here, we are assuming that we are here. And if we are here, we are assuming that we are here, okay? So that means that when you have a rating through the cycle, okay, let's say, while point in time would produce here clearly a better rating than here, okay? Because here we would be incorporating the fact that the economic cycle is positive and here it's negative. Other things equal, okay? So if you have ratings point in time versus through the cycle, there is a major difference in terms of what you get in terms of default rates, or if you want PDs, and what you get in terms of migration rates, i.e. changes of ratings, okay? In point in time, the default rates are very volatile, they are unstable, because basically the rating changes across the cycle. And clearly, here we have more default than we have here, okay? And they're much more stable here because we're basically not taking that into account. But at the same time, here we have much higher migration rates than we have here, okay? So migration rates tend to be higher through the cycle. And we can see that here. Let me give you an idea. This is a one-year transition matrix for Standard & Poor, and this is a one-year transition matrix for KMV. And so this is the, what is a transition matrix? I guess you probably heard that already. This is the initial rating, and this is showing you how many, for example, in the first row, it's showing you how many of the ones that were AAA rated at the beginning of the year are still AAA after 1 year, have become AA, have been downgraded to single A, triple B, and so on. How many did default after 1 year? 0. Okay. Triple B, how many did have been upgraded to AAA? Only 0.02%. How many have been upgraded to AA, and so on? How many did default? 0.18%, and so on. Okay. Now, what is the major difference between these two transition matrices? Of course, the transition matrix for KMV is based on distances to default. A company gets downgraded or upgraded based on its distance to default. Now, what is the major difference you see between these two matrices? Anyone wants to guess? No one? Now, the major difference that you see is the diagonal. Look at the values in the main diagonal. These are very high, around 90%. These are much lower, which means that you have much higher values in the other cells, which means that here the rating is much more stable, so there are less migrations because they are rated through the cycle. And here you have many more migrations, i.e. many more changes from the initial ratings, okay? i.e. there are higher transition, higher migration rates, okay? Okay, to recap, KMV, of course, has a number of advantages, but it also has disadvantages because it requires a lot of market data. It can only be applied to listed companies. There is a private firm model which is trying to apply the same logic to non-listed companies, and this is done by, in some way, benchmarking a non-listed company to a peer group of listed companies, but of course is not working as well, okay? And of course, it's a model based on the contingent claim approach of the option pricing framework, and therefore it's assuming that equity markets are efficient, which of course is not always the case. The private firm model is a model that, as I mentioned, tries to benchmark one non-listed company to a sample of listed companies that are similar in terms of industry, in terms of profitability, in terms of size, so that we assume that the same data that we have estimated for the listed companies, i.e. asset value and asset volatility, can be used for non-listed companies. But of course, I must admit that is not working so well. And in practice, the KMV model is very much used for large borrowers, for large corporates, especially for bond portfolios. It's not very much used for SMEs, for small companies, okay? Again, this is showing you, for example, the evolution of EDFs for different industries during the financial crisis. You can see how it went up very significantly, and gives you an idea of how it can be used. Okay, we have a number of questions and exercises. Let me first ask if there is any question or doubt on what we saw today. Okay, let's look at a couple of questions and exercises. Number one, the following table reports the continuously compounded returns on single A corporate bond and government bond with residual maturity of 1 year and 2 years. Assuming zero recovery, calculate the 1 and 2 years expected loss rate for the risky securities and highlight the main assumption limitation. Okay, here you have, of course, the Excel file. I also reported the values here. These are the 1 year and 2 years risk-free rates. Those are the risky rates. Therefore, these are the spreads, and the expected loss rates are computed using the equations that we saw before. And you have here the Excel file, exercise 1. Okay. Okay. And company 2. Sorry, second question, Company Alpha pays on 1 year zero coupon bonds at 2% spreads over the yield of treasury bonds with the same structure and maturity. On the 2 year zero coupon bond, the difference with respect to the equivalent maturity is 2.5, so the spread is increasing. Knowing investors expect in case of Alpha default a recovery rate of 1/3, so in this case the recovery rate is positive. Compute the risk neutral probability of default if the market is implicitly assigned to Alpha for the second year. Again, we can use the same equations. Those are the spread for the first year, for the second year. We can compute the implied probabilities of default using the equation for 1 year, for 2 years cumulative, and of course we can also compute the second year one. Now, of course, the first year, the marginal one is the same. The second year is different, and it can be computed as it is shown here. Okay. 3, the Merton model proves that a loan to a risky company corresponds to a portfolio composed of a risk-free loan plus. What is the correct answer? So you are the one lending money to a risky company. Your position is equivalent to. What is the correct answer? Come on. No one wants to try? See? No, be careful. I mean, you are the lender, so you're not a long position on the put option means you're buying a put option, okay? In this case, you're actually you have a short position. You're selling a put option to the shareholder. So it's actually B, the correct answer, okay? Okay. A company having assets worth 100 million with a volatility of 15% is replacing all its debt with just one large loan with a face value of 85 million euros and a maturity of 2 years. Risk-free rates are currently at 6%. Using the Merton model, check whether the fair rate to be applied to the loan could be less than 6.5. Also, suppose the company is willing to raise 20 million of new equity to be invested in such a way that asset volatility will stay the same. Do you think the fair loan rate would decrease? Do you think it would be less than 6.1? Okay, I mean, this is a bit, of course, complex, so it can be computed with Excel. Here you have all the inputs: value of the assets, value of debt, time is 2 years, risk-free rate, volatility of the assets. Based on the framework we saw, we can compute leverage, D1 and D2, and the first spread and risky rate, which would be 6.5. So it's actually asking whether it could be less than 6.5. No, it's 6.52. After the capital increase, of course, the asset value goes to 120. Asset volatility remains the same. I can do the same computation, and the spread goes down very significantly, of course, because it's all equity increase, and therefore the leverage has significantly decreased. Okay. Of course, you have the Excel file where all these computations are actually done. Okay. Finally, which of the following information is not necessary to estimate the expected default frequency of a listed company using the KME model? Volatility of equity returns, the market value of the company's assets, the company's rating, the accounting value of the company's debt. What you don't need in the KMV model to compute the, come on. The correct answer is C. You don't need the company's rating, you need all the rest. In the KMV model, the distance to default is expressed as, what's the correct answer? Come on. C, correct, yes, in the same unit measure as the one of the company's asset standard deviation. And I leave you this question for you. The correct answer is A, okay? We are a bit late. Okay, so I'll see you next week, and you have a nice weekend.